Hi, good morning, and welcome to Saxo's weekly market outlook call. We'll just give it a few more seconds for some more people to join in. Okay, hello again, and welcome to those of you who just joined us. This is Saxo's weekly market outlook call. I'm Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today with Jess Amir, who's a market strategist from Sydney. So I have really been actually missing from this platform for quite a few weeks, and it's good to be back, especially because it is such a pivotal week that we have ahead of us. Today, I think broadly, if I lay down, we'll cover three big things today. The Fed pivot expectations. They've been obviously largely trading market behavior over the last week or so. We'll also touch upon the progress on the Q3 earnings season. And we've had some of the biggest tech names, the reports last week, but we still have a lot of crucial names ahead of us this week. So we'll touch a little bit on that. And lastly, of course, the commodity markets remain very interesting with what's been going out on in China. And our China expert Redmond is still missing from the scene today, but we will look at what those China stories could mean for the commodity markets, and we've also have some geopolitical developments over the weekend. So we'll try to cover that in a bit of detail as well. So just on the first one to start with, we've had some of the central banks, making that shift to a pace of smaller rate hikes, starting with the RBA and then followed up last week with Bank of Canada, but more importantly, the ECB as well. Now that, together with some of the noise that we've heard from Nick Timiraos, who is touted to be a Fed messenger, he wrote about how the Fed at this meeting would be looking at, conveying a downshift in its rate hike path from here. So because of all of these reasons, now there has some expectation that this week's FOMC meeting could be really key, despite the fact that we get another 75 basis points rate hike, which is fully priced in. The central bank will likely start preparing the markets to move to smaller rate hikes of, say, 50 basis points or 25 basis points from the December meeting onwards. But now I think the story here is that these dovish expectations have been set in. So it will likely be hard for the Fed to surprise dovish anymore. And if you look at US economic data, that has been, largely still strong over the last week or so. We've had the GDP data, we've had core PCE, not really strong, but not weak enough to really, again, justify a downshift there. We should be watching for ISM manufacturing, which is due tomorrow in the US, but main focus will be on the labor market data on Friday, which is anyway after the FOMC meeting. So what that could mean for the markets is that FOMC could bring a sell the fact reaction, or rather the buy the fact reaction when it comes to the US dollar, which has been down over 1% last week. So if they do not surprise more dovish than what is already expected, we could see some of those gains to US dollar return this week. But let's shift gears here a little bit and talk about what that could mean for equity markets. Bringing in Jessica here, and also, of course, Jessica, let's also touch upon the earnings front, what is due this week, really.
Yes, thanks, Charu, and hello, everyone. Yeah, as you said, there's absolutely a lot on the line. But I think what we need to do first, if it's okay, True, and everyone, is just pause and reflect on where we're at. So far, we've had quite a few companies report in the S&P 500, and that kind of also supports this notion that we have seen stocks trade at their highest levels in a couple of weeks. But when the rubber hits the road, 263 companies in the S&P 500 have reported, and it's a very slim margin that have actually delivered earnings surprises. Nevertheless, there have been more earnings surprises than disappointments, so that is supporting the risk on sentiment. Coupled with the fact that we are starting to get a little bit of signs that the Fed, as you said, could potentially be pivoting. So if you think about those numbers, so about 4% of the S&P 500, it's just 4% of the S&P 500 companies that have reported so far have delivered stronger than expected results. We know stronger than expected results support equities. The other thing, Charu and everyone, that we need to remember is, of course, earnings drives share price growth. And so far this earnings season, although we have seen some surprises, earnings growth has been pretty muted. So this is what we're a little bit cautious of at the moment. So average earnings has only gone up about 2%. So you strip out the earnings growth that you've had from energy companies. Remember, this season, energy companies have still delivered the most earnings growth for the third straight quarter. So 140% earnings growth come from energy companies. And then you strip out that and you're basically left with 0% earnings growth. So this is a bit of a concern. Also, going back to this as well, we're seeing that price to earnings ratios are kind of at their lowest levels that they've been since 2008. And so this means that, forward earnings are dropping, and prices have also dropped as well. So it's good for long-term, absolutely long-term bargain hunters, but for short to medium upside, we are still quite cautionary. That being said, we need to bring in Steen's thinking here, if we may. And so Steen has recently, our CIO, has been speaking about, are we there yet? Are we at the bottom yet? And he is telling us to basically look for three things: the consistent turning over of the US dollar, number one; number two, consistent turning over of bond yields; and number three, the volatility index falling from its high. So we still don't believe we're there yet, but Steen says maybe, just maybe, this could potentially be the start of a bottom. He said maybe we're wrong. So he's putting a bit of a toe, I guess, in the water. So this comes back to the thinking of why equities are seeing a rally and why they're picking up from their lows. That being said, we do have to reflect on what we had last week. So stronger than expected, mostly stronger than expected news from Apple. And that's why tech stocks rallied markedly at the weekend. So Apple shares were up over 7%, and that supported the NASDAQ back to multi-week highs. We also this week have lots of earnings on tap, and just touching on the earnings that we do have. So we've got some big proxies that we'll be watching closely. So in the chip space, Advanced Micro or AMD, also Qualcomm. And so we're watching those two tech companies as a proxy for what we can expect for the outlook for these major tech companies, and also in the consumer staples, I guess, spending space, we've got Starbucks. So will we see that consumers are still going out and snapping up coffees despite recession? Well, we saw that with McDonald's last week. McDonald's reported stronger than expected results, and McDonald's shares were higher as a result. So Starbucks is perhaps one to watch. But of course, the big one to watch, Charu and everyone, is Exxon Mobil. One of the most traded oil names, and the investment house or the investment company Berkshire Hathaway. So they'll be quite interesting to watch, Charu.
Great. Yes. Quite a few names to watch, and especially I think with the kind of volatility we've seen in the stock markets, I don't think Starbucks will have any problem selling its coffee. But let's see where we go there. We also have some key Japanese names reporting this week: Toyota, Sony, the likes. I think important to watch, especially to assess the impact of the very weak yen that we've seen in this quarter. So I think, yeah, just keep that on your radar as well. Okay, besides the Fed, there are some other central bank meetings as well this week, which will be quite key. We have the RBA tomorrow, which is now on the dovish tilt as we know it. So that could potentially remain a short there. We have the Norges Bank and the Bank of England on Thursday as well. In terms of the UK policy, I think the new administration that is in place has kind of stabilized things for now. But my sense is that, all the good news has really been priced in. Let's not forget, they still have a recession coming. Fiscal policy will remain hard to manage. And, we've seen a postponement in that fiscal policy strategy meeting for now. But again, I think sterling has really priced in all the good news. So scope is only for disappointment, from them. A lot is happening in the Japan side as well. We had the Bank of Japan standing pat on Friday as expected, but there was still a big budget announcement from the Kishida government. Now, what that means is that demand destruction will remain tough, which is not the ideal scenario when you have a situation where energy prices are rising and the yen is so weak as well. So it is a similar situation to what we saw, in the UK with the mini budget in September. But there, the pressure was released on the gilts market. Here, I think for Japan, the loan pressure valve will be the Japanese yen because yields still remain capped, right? So despite the intervention that we've seen, I think USD yen remains poised for more upside, especially if US yields return higher this week. So I think, again, keep that in your focus as well. But now, again, let's switch gears to commodity markets, so especially iron ore, I think, just being very important, and maybe other metals as well, with the announcements that we've seen coming from China. And then over the weekend, we've had, heightened geopolitical tensions with Russia pulling out of the Ukraine grain deal as well. So that kind of spooks risks of a global food crisis as well. What are you watching in the commodity markets this week, Jess?
Yeah, great points, some great questions. I'll just start with the ag space. So it's really important to mention what actually happened was Russia actually pulled out of the agreement, for the Black Sea region. So that basically means that they're probably toying with the idea, and some Russian officials came out saying that they were going to halt exports out of Ukraine. So this means that traders are bracing for a spike in food prices. As a result, we have seen the wheat price spike up in early trade this morning, and we'll be watching corn and fertilizers as well. So here, given that we kind of like preempted this to occur again, our thinking is that unfortunately we're going to see higher food prices, not good for the consumer. For traders, this looks like it's going to transpire into another potential opportunity. So in grains, you could either look at on the Saxo platform, wheat, corn, soybeans. So they're the ones that we're watching. In stocks, the stocks, I guess, I prefer to look at larger companies. So in the US, you've got the US biggest grain producer or wheat seller, General Mills. That is one to watch. GNC, Grain Corp, is Australia's biggest grain company. And then fertilizers, of course, Ukraine, Russia, very big fertilizer companies. So typically, if we think about what happened prior to this global geopolitical tension, we did had annual wheat and barley exports. About a fifth or a quarter actually came from Ukraine, etc., came from out of the Black Sea, and about a fifth of corn came from Ukraine, Russia as well, and a lot of fertilizers came from the region. So now these markets, I guess traders will be bracing for more upside, is what we're trying to say. So going back to fertilizers, so the companies that we're watching are CF Industries, Archer Daniels, so those two. And then if you don't want to stock pick or there's too many companies, why not look at 3 ETFs? So the 3 ETFs that we're watching are probably two of the biggest. The first one is Invesco's DB Agricultural Fund. So Invesco's DB Agricultural Fund. And the second one is iShares MSCI Agriculture Producers ETF. If you're in Australia, the ETF food, FOOD, could be worth a look. But just going back to what you first mentioned, Charu, really important to mention what actually happened in not last Sunday, but the Sunday before, was that President Xi actually came out affirming their strong state controls and their strong COVID measures would continue to be in play. And this is one of the reasons why we saw Hong Kong's market fall 8% last week. We also saw we also saw the key commodity stocks that are that China typically buys a lot. When I talk about stocks, I mean literally buying stocks, as in goods. So iron ore, copper, etc., aluminium. So the iron ore price fell 15%. So the iron ore price has now unwound 3 years of gains. So the iron ore market was in a bear market. Now it's fallen much deeper into that. So big takeaway here, please take note, as a house, we now think that markets, secondly, businesses, and thirdly, commodities with high exposure to China will probably face continued selling. And the reason that we think this is because Xi came out and affirmed his heavy-handed stance. And then on top of that, on Thursday, late last week, China tightened their COVID restrictions. So we're continuing to see iron ore stocks suffer. And this is something that we're expecting to be compounded upon by the fact that Australia's largest metal exporters are actually ramping up production. So Fortescue Metals, Australia's biggest pure play iron ore company, is ramping up production. So this is actually spooking the iron ore market into major fears of oversupply. So we're likely to see further iron ore pressure from here. So perhaps time to revisit your iron ore position. Charu, sorry, there was a lot to say there.
Yeah, no, totally interesting. Iron ore is steel and it is slowing due to the property slump in China and the general economic slowdown as well. But I think we still like copper much more because of the relatively tight supply there despite these current headwinds. I think it is one of the few metals also where China has seen a pickup in imports during this past year. So potentially, I think, we need to keep on watch that as well. Speculators are still holding a, neutral to bearish view on copper. But I think that's more of a technical, outlook at play, which needs some improvement. So I think if you look at copper, I mean, I think the support at 350 has been quite key there. If we can, comfortably break above that and push speculators out of that market, I think copper still remains one of our favorites, at least in the industrial metal space, where most of the other metals are suffering because of the slowdown in demand from China. But that's it from me as well. And I think let's stop there. Jessica, do you have anything else to add?
No, I was just going to say I'm total in agreement with you. In fact, I saw a stat on Bloomberg about copper. So annual demand for copper tipped to grow by 52% versus supply only expected to increase by 16%. So yeah, absolutely affirming the dollars and cents affirm our stance on potentially being overweight for copper for the long term, but still waiting to see further downside in the USD before copper really makes a run for its money. But yeah, I think we'll leave it there, Charu.
Awesome. Okay, great. Have a good day, everyone. And of course, feel free to kind of reach out to your sales reps or, strats for any further discussions or anything. We'd be happy to help. And that's it from us. Then have a good day, good week, everyone.
Thanks for your company. Bye-bye.